Hello, everybody, and welcome to the Vetted VA Mortgage Market Update. I am Hammer J. Helmer, and I will be here by myself today. So, thank you for joining me. If you're here live, do me up. No, I'm not.
Not so
Here he is,
fast. I'm back.
the man, the legend. Hold on, I got to put the headphones on. All
Man.
right.
Thanks for
So,
launching this.
anyway,
Get started.
no problem. Like I said, I'm here with Nathan Nottingham. And if you guys are watching live, it's a great day to be watching live because we're getting in before some market action with the Fed meeting today, and we'll talk about that. But if you're watching on the replay, do us a favor, just in the comments, put hashtag replay, that pound sign, hashtag replay. Let us know that you were watching. If you have any questions during the live broadcast, feel free, go ahead and put those in the comments. We'll be monitoring those as well as on the replay. If you have any questions, we do monitor those as well. So Nathan, since we did launch right in, was there anything you wanted to share, or do you want us to just keep going and talk about what's going on this week?
Let's do it. Let's dive right into this.
All right. So, everybody, I apologize that we missed you last week. We were at the Vetted VA summer camp, which was fantastic, and you guys did a great job. We'll talk about that later. It was a great time had by all, but so we didn't miss much last week. Rates improved a little bit last week, and mainly as markets were preparing for this week in the Fed meeting. So that is the big thing that's moving things right now is the actual Fed meeting. So I'm going to share my screen. I want to show you guys some stuff and kind of give you some insight into the depth of what we prepare for a day like today with the Fed meeting. So first thing, I want to bring you just to a good old Bloomberg article. This says a great summary. And basically, the today's Fed meeting, they're going to raise what's called the Fed funds rate. And one of the biggest misconceptions out there is that when the Fed raises rates, which they are going to do today they'll announce it in about 2 hours. And they're expected to raise rates 3/4 of a point. And a lot of people say, oh my goodness, mortgage rates are going to go up 3/4 of a point. And that's actually not what's going to happen. What the Fed is going to do is they're going to raise what's called the Fed funds rate. The Fed funds rate is the rate of overnight lending between banks. And it sounds like it really shouldn't have much of an effect on anything except for the banks. What happens is banks are required to have certain capital requirements based on, what has happened that day, how much money they've lent out. They have to have capital reserves to protect our banking platform, our banking system. And if they don't have enough money, let's say Wells Fargo, send out a lot of loans and they need a little bit more capital. They need a little bit more in their asset column. They'll turn around to maybe, Chase, and they'll say, okay, hey, can we borrow $1 million? And Chase will say, sure, no problem. And they lend Wells Fargo that $1 million, and the interest rate is set by the Fed as the Fed funds rate. So this rate of what banks lend each other in overnight lending, really, you'd say, okay, why does that have such a strong effect on the economy? And I don't want to get too far down the rabbit hole because there's a lot to talk about today. But basically, what happens, it affects the short-term lending between banks and also just so many other things out there: student loans, car loans, home equity lines of credit, but not necessarily fixed rate mortgages, and also credit card loans, student loans, auto loans, title loans, all these other short-term loans. So that's why it's so watched, because the Fed, by raising the cost of borrowing, is slowing down the economy. When money is flowing freely and people can borrow, that tends to heat up the economy. So for example, if you can borrow, a couple $100,000 to invest at a very low interest rate, you can invest that in your infrastructure, in your business. You can invest it in higher inventory. So a lot of businesses will borrow money when lending is cheap, and it drives that business forward. As lending becomes more expensive, now they start to slow that down, and that slows business down as well. And that's going to ripple through the entire economy. So the Fed is using the Fed funds rate to try to slow the economy down. The reason they want to slow the economy down is inflation. We've talked about this on many of our past calls. Inflation is the big thing, and I'm going to take the screen off for a minute just so we can all see. So inflation is the 800-pound gorilla in the room. Inflation driving up the cost of gas, driving up the cost of food, driving up the cost of everything. So inflation is a very big problem, and the way that the Fed tries to get inflation back in check is by raising this Fed funds rate, by slowing down the economy, and that generally will diminish some demand, which allows that supply demand to level out, and that drives prices down. So for example, Walmart right now has been, stocking up huge on inventory. Well, consumer demand is starting to slow down. It's starting to drop. People are feeling the price pinch. They're not buying as much. So now Walmart has too much inventory. So how do they get rid of excess inventory? They lower prices. They lower prices to get rid of that. And then that ripples through the entire economy, because so Walmart says, hey, we're going to make a little less this quarter because we've lowered prices to get rid of some of these goods. So Wall Street says, oh no, stock on Walmart worth a little bit less because they're going to earn less. And that's how all of this ripples through the economy. Now, you guys as home buyers, as homeowners, if you're thinking of refinancing or you're wanting to buy a home, how does all of this affect you? Well, that Fed funds rate, as that rate goes up, mortgage rates go up. However, there's a trick to that. Mortgage rates go up much earlier. So as the markets and the investors speculate on what's going to happen with rates, we start to see mortgage rates react ahead of time, because investors are trying to get in before the game. They want to act early when they can make money. So today we're going to see the Fed raise rates most likely 0.75 of a point, but that's already been worked into mortgage rates. We saw mortgage rates go up earlier in the year on the forecast of all the different times that the Fed was going to continue to raise rates through this year. And when the Fed actually does raise rates today, we actually see a rebound effect. What we see instead of mortgage rates going up is mortgage rates may actually get a little bit better. So let me show you back to that article, and let's talk a little bit about what we think is going to happen today and why. So the Fed, they're expected to raise rates by 0.75 of a point. The way that we figure out what the markets are pricing in, we look at tools that affect what we call the Fed's target rate probability, or the Fed funds rate. There's actually trading going on. There's all this betting. When you look at Wall Street, it's really just one big betting parlor. And they're betting on what do they think the Fed is going to do? Where are rates going to go? So I'm going to refresh the screen and we'll see if the 76% changes yet, because this every 15 or 20 minutes, we'll see this change going up to the meeting now. And I just want to see what the most current, so it's still 76%. So basically right now, what this chart is telling us is that 76% of probability that we're going to see a 0.75 point rate hike. The Fed funds rate is going to go from 1.5 to 2.25. And we're about 20% or maybe 25% believe that they'll see a full 1 point rate hike, which I don't even remember when the last time we saw a full 1 point. I think it's happened before, but I couldn't find when that happened. Wow. So today, if the Fed were to raise rates by a full 1%, even though that was actually a higher amount, you'd probably see mortgage rates get better, because that's going to help slow down the economy, slow down inflation. And it wasn't what was expected. It hasn't been priced in yet. Instead, when the Fed raises rates by 0.75 of a point, they're going to make that announcement at 2 p.m. Eastern today, about an hour and 45 minutes from now. And when they make that announcement, they're going to have a whole statement, and the investors are going to analyze every word of that statement, looking for what's going to happen in September. That's the next meeting. It's September 21st. And right now it's about a 50-50 belief. 50% believe that we'll see another half a point rate hike, and then 50% believe we'll see a 0.75 point rate hike. So depending on that, we could see mortgage rates now react to what we think will happen in September. So we already know that the 0.75 point rate hike is at a minimum a given for this month. It's already assumed. It's been priced into your mortgage rates that you see today. So when the Fed does raise rates, you're not going to see mortgage rates go up 0.75 of a point. You could actually see them maybe improve a little bit. Most likely it won't be your rate itself that'll change, but maybe that rebate pricing, the credit you get towards your closing costs, or the cost to buy into a better mortgage rate, your closing costs will probably get a little bit better. And we forecast that based on, generally what has happened in the past, and how markets are, going to react to that. So for anybody in the know, for all of you guys, you generally want to see, hey, I want to see what's going to happen today when the Fed does go ahead and raise rates, and when they raise those rates. So right now, the size of the hike expected, like we talked about, is expected to be about 75 basis points, or 0.75 of a point. There was some expectation earlier in the month that we could see a full 1% move, but that was, basically pushed back out of the way by some of the different Fed members who go out in their public policy talks and they say, I don't support that. And what investors look at is this a voting member? So some members get to vote on the rates, some members don't. And everyone looks and says, okay, well, is this a voting member? Where do they stand on this? So for example, Governor Christopher Waller, who's a voting member, St. Louis Fed President James Bullard is a voting member. They expressed a preference for 75 basis points, and they're being transparent to the market, saying we think that this is the right step to make when we get to that meeting. So everybody's expecting these members, as well as a few others, have supported that idea of a 75 basis point hike, and that's what the markets are currently expecting. When they talk about dissent here, there's a few members that think that maybe that's a little bit too high. And those members are generally called dovish. Members that are for aggressive tightening are called hawkish, and the other ones are called dovish. So you can kind of see where those birds fall in. So Fed Kansas President Esther George is one of the more dovish members. She favors a 50 basis point increase. She is also a voting member, and she's expected to vote for a smaller increase this meeting as well, but she'll probably be outvoted. And we expect to see that 3/4 point rate hike. A couple of other things on here. The statement is what everyone's going to look at. So at 2:30, the Fed releases a prepared statement, and investors are going to comb over it word by word, and they're looking for changes to even small sentences like the committee is highly attentive to inflation risks. Well, that's something that we've heard in the past meeting. It was in the June statement, and that's what the markets want to hear, that the Fed is aggressively looking to bring down inflation, and that'll help your mortgage rates. Now, if there's any change to that language, if there's a tweak to that sentence, that could be construed as an acknowledgement that the Fed is more attuned to the economic risk. Because here's the problem. When the Fed is raising rates to slow down the economy, to bring down inflation, they're also causing a situation that could lead to a recession. And that's right. What's been so good for mortgage rates recently. So I've talked about the horse race before. We've got two horses in this race. We've got fear of recession and fear of inflation. So fear of inflation, that pushes your mortgage rates higher. Fear of recession, that brings your mortgage rates lower. So the expectation now is, as the Fed continues to take these aggressive moves, raising that Fed funds rate, hiking rates, that is supposed to bring down the fear of inflation, but it's going to increase the fear of recession. That helps your mortgage rates improve over time. Now, we're not likely to see mortgage rates make dramatic improvements. We're not going to see, if you're in the high fours on a VA loan, which many are, we're not going to see those fall into the 3% range. But maybe you see it get 1/8 of a point or even 1/4 point better over the coming weeks. That would be something that could happen. So we don't have a crystal ball. Just like when we forecast weather, we're looking at all the variables. We know how they've come together in the past, how that's led. And that's kind of what we put together to say, this is what we think can happen in the future. So today, we've talked a lot about that Fed statement. That's going to be at 2 p.m. At 2:30 p.m., Fed Chairman Jerome Powell is going to come out in a press conference. He is going to be asked a bunch of questions. A lot of those questions are going to be about what happens in September. What is the Fed going to do moving forward? Again, since our markets react ahead of all these moves, investors and markets are going to be listening to Fed Chair Powell's answers to those comments. If it sounds like they are aggressive, fighting inflation, talking about increasing rate hikes, that could actually be good for mortgage rates today. If they say, well, we're starting to see moves and we think that we can start to dial it back, we could see mortgage rates actually not like that news and maybe get slightly worse on the day or tomorrow. So that's kind of what we've got going on. Now, if you're closing sometime soon, let's say you've got a loan closing in the first couple of weeks of August, you need to be talking with your lender or your mortgage broker, and you need to have that conversation of when is it right for you to lock in that rate and protect that rate. One thing that I would be aware of if I'm closing in the next couple of weeks is that on Friday, we're going to get an inflation report called the Consumer Price Index. As well as part of that, you get what's called the Core Consumer Price Index, which removes energy prices and removes food prices because those are considered volatile. That's an inflation report. If we see that inflation has started to come down, that could be good for mortgage rates. That could actually help things improve. But if we see that it hasn't gone down, if it stayed the same or possibly even gotten slightly worse and it hasn't peaked yet, that could be bad for your mortgage rates. So if you're closing over the next couple of weeks, you want to see what happens today with the Fed meeting, and then you've got to decide where you want to go heading into the weekend in that Friday report. But for loans that have more time, if you're in a new construction home and you've got lots of time, or if you just went under contract, or if you're out house hunting, then I wouldn't worry, because there's not a need necessarily to worry about rates jumping up right now. And I think that it's a good time to float that interest rate if it were me. And if, again, I'm giving you guys just some advice, but based on generally what we expect to happen as that fear of recession continues to grow, we'll see mortgage rates chip down a little bit at a time. And it's not going to be big moves. They're not going to drop significantly, but a little bit at a time. So if you are out house hunting, or if you're already under contract, but you don't close for a while, it's a good time, because it's very likely we will see rates get slightly better rather than get worse. And if you are closing very soon, you have less time to recover from short-term moves. So you've got to make that decision of when it's time to lock in. And you should do that talking to your mortgage professional and then, yourself. So what do you think, Nathan? I think that kind of summed it all up.
The easiest way I've ever thought about it is you have a balance, right? The economy wants to balance. That's where we want things to be. And if you start sliding one way or the other with recession or inflation, we're trying to find a way to balance, and you're always moving the fulcrum, right? You're trying to get to the balance point. So as you're thinking about what's happening out there, they're trying to utilize economic pressure and indicators to find the fulcrum of our current economic structure. And that's what, so don't freak out when you hear interest rates rise. It's the cost of borrowing money. There is a cost, and a debt is a way to actually guard against that cost. So like you said, if you're out there shopping, get qualified for today's rate and get qualified for what the rates may look like a little bit above, right? Know your margins, know your left and right lateral limits on your borrow capacity and your structure. We've seen some posts lately in VettaVA where people were doing new construction. It's been a year since it broke ground. They did all their baseline planning on interest rates a year ago. Now it's getting closer to actually getting their interest rate locked in, and they're going, I can't afford this. They were at the top of their margin at 2 or 3.5 or 4%. Then just moving the needle over. Now they're like, okay, we can't actually afford this payment at the current rates where we would lock in on this one. So stay flexible. Movement is life, and know your limits on your affordability structure. And when you're getting pre-qualified, pre-approved, you're out there shopping. So those are really key components. I appreciate that, the Hammer, though. You did a great job, man. I love your emails, and I love getting that straight from your wisdom bucket, also known as your brain.
Awesome. Well, thank you. And is there anything else? Otherwise, like I said, if you guys have watched on the replay, do us a favor, give us a hashtag replay. If you have questions, feel free to ask them. The quick summary, too long didn't read, is that there's no need to panic. Rates should stay where they're at, get slightly higher, but come back down, and could get down, maybe a quarter point or so over the next week or two would be a nice move. Can't guarantee it, but I put in the request. So we've got the requisition form all filled out for you.
I put in the request. I love it.
Yeah.
I think you have, I'm just going to plug your stuff. You never plug this, but I'm going to plug this, that if people are interested, they should subscribe. You do a daily email on information like this, and it's quite interesting in the marketplace. Are you good if I share that?
Yeah, I just want to put the caveat out there because we're in, a couple of different vetted VA groups. It's generally meant for mortgage professionals, but it is written at a level that as a consumer, I've had a lot of consumers that end up, subscribing and reading it. It is written that as a consumer, you'll understand it. So, but just recognize that it is written for mortgage professionals for sure.
I'll drop those comments in later on, and we'll get that set up. But appreciate you. Thanks for making time, brother. And everybody, I hope you have good luck finding your houses this week, and stay true to the mission.
Yep, absolutely. Thanks, y'all. Take care, everybody.
Bye-bye.